ago. It's been a 10x. A consumer name has become a 10x in last 5-6 years. Krishna Kumar joins us now. Krishna Kumar joins us now. He's head of equity with Sundaram Mutual Fund. KK, morning. Thank you for joining us. KK, this market surely has managed to climb the wall of worry. Do you think in the short term, when I say short term, 3 to 6 months, this is the best we can go? Because right now the force of liquidity is favorable. The force of earnings is decent. But markets also have made a comeback. Nifty is up 7% from the recent low, and the small cap index is up 10% from the recent low.
Yeah, I think the corporate earnings have been pretty good, and interactions with corporates show a lot more confidence on the business and the outlook at this point in time. That is getting reflected in terms of the markets, kind of also moving up. While large caps have been doing very well in the current calendar year, the rally is now getting a lot more broad-based, as you mentioned. From just about 5-6 large caps moving the Nifty, we had a more broader participation in the large caps, and that is now spreading across sectors into the mid and small cap space, more in the mid cap space at this point in time. Post all the issues in terms of additional surveillance margins, SEBI rationalization of schemes, which impacted mid-caps, etc. There is definitely technically a bit of pause there, and fundamentals again will come back to play, with earnings growth being quite good in the first quarter, and mid-cap companies have delivered well. So we see this rally actually getting a lot more broader and wider, and not necessarily the indices moving higher, but the participation will increase across the board, is what we see. There aren't too many events that are lined up in the next couple of months till the elections in both US and in India. So in terms of state elections here, so we see a fairly stable market conditions into the next 3 months kind of, and then again elections, etc. will bring in that amount of volatility in expectations and markets.
KK, aside of that, what we're also seeing is, and this is a really positive move, I would guess, that there is that sectoral churn which is happening. So, while we were cribbing about the fact that it's only those 10-15 names taking the Nifty higher, it may be 10-15, but it seems like there are the newer 10-15 which want to take the index higher. So, I mean, the re-emergence of an ICICI Bank, it's been a solid 27% move from the stock in just a month gone by. There's been SBI which has made a move. There's been Axis which has made a move. And pharmaceuticals as well as the sector has chugged along. Do you see that there will be more names which would now participate in this index rally which is playing out, and the sectoral churn is something that is going to continue for some more time to come?
Yeah, exactly. I think that's the way the markets will move. Clearly, if you look at banking space, you had a lot of move in the high quality names, if you may say so, and the corporate lenders have been beaten down because of the worries on stress, etc. Now that we are at the end of the resolution cycle, and the NPLs and the provisions are kind of picking out at this point in time, I think there is a clear value emerging in the big ticket corporate lenders at large. So these being large market caps and names, there is going to be a fairly large shift away from those richly valued private banks, and that would move into the corporate lenders. And at the same time, other sectors which have been lacking growth drivers and have shown some semblance of bottoming out, like in the pharmaceutical space, we are getting to see investors valuing them on the domestic business, which is pretty large chunk, given that the generics have been taking a big beating. So we are seeing that there is value emerging in the pharmaceutical space also, given that these big names have a significant presence in the domestic markets. So there is definitely a move away, and rotation that is happening. Again, if you look at the infrastructure companies, the EPC construction companies, cement, these have been beaten down badly in the last 6-8 months, and we see that there is again a lot of value there. So we do expect a lot of money to move into those companies with good growth and visibility in the next 1 year.
Do you get the sense that, while the index is doing what it is, evaluating the potential of the upside for a mid-cap portfolio is getting limited, especially amidst the volatility and the kind of sell-off that we've seen there? What is the strategy that you're approaching to manage your mid-cap funds, your small-cap funds?
Yeah, definitely, there has been a significant polarization of interest towards the large caps away from small caps in that order. We definitely do believe at this point in time that the significant valuation premiums that the mid and small caps enjoyed over the large caps have come down. For example, if in December the mid cap indices were trading at about 30-35% premium to the Nifty, that's down to about 5-6% at this point in time. The small cap indices trading at about 15-20% valuation premium are down to minus 12% a discount. So I think the last 8 months have given a fair bit of time for consolidating on the mid and small caps, both in value terms and time terms. So we see that with the growth coming back and it's quite broad-based in the economy, the valuation concerns are gone and earnings will drive these mid and small caps. So I think it's a good time to continuously add to the mid and small caps now and hold to what we do have. From a portfolio strategy perspective, we have always relied on high quality growth companies basically, and we've been having a more buy and hold approach to investing, and that will continue. However, as we discussed earlier, there are pockets of value emerging, where growth is also kind of coming through. So our belief was always that value definitely performs only when growth kicks in, and that's possibly visible in some of these sectors like pharmaceuticals, cement, and infrastructure, EPC construction names. So that's where the attempt would be to find some value drivers there.
Very large holding in auto ancillary, whether it is Mahindra CI, Sundaram Clayton, Exide, again it's an auto ancillary company. Why are you so bullish on autos? Because globally we don't know which way exports would move because of this entire electric vehicle challenge. Locally, again, we can argue if Maruti is doing well, Tata Motors is not doing well. If Leyland is doing well, then there are challenges for other companies like Mahindra and Mahindra. So why is auto ancillary a major part of your mid cap allocation? I mean, it is one of the major core of your portfolios.
Sure. Clearly, I think Indian auto companies, auto component companies have multiple drivers. Definitely, as you mentioned, there could be a player who's not doing well, but others are benefiting. So when we look at an Indian auto component player, he typically has about 50-60% of the business coming from the OEMs, and given it's diversified across commercial vehicles, two-wheelers, cars, tractors, etc., there is a fair amount of steady growth in a Toto that you see, even though a Tata Motor may not do well or a Maruti may not do well in bits and pieces. The second part is that another 30% to 25% comes from the auto aftermarket and the spares market, which is a very steady market. If the economic conditions are good and the growth is about 7-8% in the economy, things are fine in the space. That's a steady growth business and a higher margin business. Lastly, exports are between 10 and 30% for different companies, and these are definitely long-term contracts and where you do have good visibility in terms of growth, and that's pretty helpful. The challenges from electric vehicles is not so imminent at this point in time. Even globally, it will be another 6 to 10 years before it becomes a reality. We are definitely seeing the companies preparing for EVs, but there is a lot of challenges in terms of cost and technology and improvements to be made. So it's not a near-term worry, for at least the next 5 years for us. And particularly if you look at Indian auto scene, it's going to take more than 10 years for the electric vehicles to make a mark in India, given that there are a lot of challenges on cost and government subsidy is a big component when it comes to getting these up and running. So I think the Indian auto component sector is pretty comfortable and safe at this point in time from any business risks. And we see that the diversified growth engine is one of the fairly strong reasons for us to be participating there. And these have also good technology competence and niches that they are operating into.
Right, KK, thanks very much for taking out the time to speak with us this morning. We really appreciate your views and your insights.
Thank you.
Okay, changing tracks from talking markets, let's talk companies. Sun Group, and the case for a chat here being the digitization impact on subscription revenues, especially in the southern market.